Hello, everyone. My name is Sebenzile Dlamini. This is part 2 of the topic Access to Credit. In this session, I will talk about financial ratios. The three ratios are profitability ratios, liquidity ratios, and solvency ratios. I would like to share this quote by Jim Rohn with you. A formal education will make you a living. Self-education will make you a fortune. This is so true. The best way to learn about business is to start one and grow it. I would like to state that it is easy to calculate ratios when you have a business plan or financial reports. If you do not know accounting practices, you should at least know the financial ratios for your business. The three categories of ratios are profitability, liquidity, and solvency. Profitability ratios are concerned with the profitability of the enterprise. Liquidity ratios are concerned with the ability of the business to pay off its short-term debts. Solvency ratios are concerned with the ability of the business to pay off its long-term debts. It is important to measure financial ratios over time and to compare the business financial ratios with the industry average so that you can assess whether your business ratios are above or below the industry average. Profitability ratios are calculated with data that is collected from the income or profit and loss statement or projections and the balance sheet. This is an example of an income or profit and loss projection. At the top, you have sales income, and then you have cost of goods sold. When you subtract cost of goods sold from sales income, you get gross profit. Then you list the operating expenses and get the total operating expenses. When you subtract total operating expenses from gross profit, you get operating profit, which is also known as earnings before interest, tax, depreciation, and amortization. When you subtract the total interest, depreciation, taxes, and amortization from the operating profit, you get net profit before tax. After subtracting tax, you get net profit after tax. Profitability ratios show the ability of a business to generate profits relative to its revenue, operating costs, assets, and equity. The first ratio is gross margin. This is calculated by dividing the difference between sales and cost of goods sold by sales income. In this case, the ratio is 0.49 or 49%. It means that for every lilangeni generated, 51 cents would go to the cost of goods sold, while the remaining 49 cents could be for expenses, taxes, and other costs. A high ratio shows high profitability. The next one is net profit margin. You calculate this by dividing net profit by sales. In this case, the ratio is 0.02 or 2%. It means that for each lilangeni of sales, the company earns 2 cents in net profit. It is a low net profit margin. A low net profit margin shows a risky business. The third profitability ratio is return on total assets. To get this, you divide the net profit by average total assets. you get the average total assets from the balance sheet. In this case, the ratio is 0.04 or 4%. The return on total assets shows the utilization of assets to generate profit. In this case, it means that for each Lilangeni invested, the business generates 4 emalangeni in profit. A high and consistently rising return on total assets over a period of time is good. The last profitability ratio is return on equity. You get this from dividing the net profit by the average shareholders' equity. In this example, we're not using an average because we are using financials for 1 year only. The ratio is 0.05 or 5%. The return on equity measures how well a business uses equity to produce net profit. An excessive return on equity could indicate inconsistent profits or excessive debt. Now we will talk about liquidity ratios. I have presented an example of a balance sheet so that you can see where this data comes from. You have current assets and non-current assets. When you add the two, you get total assets. Current assets include cash, debtors, and stock or inventories. Current assets are the assets of the business that can be cash or converted into cash within a period of a year or a short time period. Non-current assets include equipment, fittings, computers, or other machinery. In this case, the total assets are 27,000 emalangeni 410. You also have liabilities. You have current liabilities, those are short-term debts, and non-current liabilities. For this business, the short-term debts are the credit card and creditors. So the total is 4,810 emalangeni. There are no long-term debts. The total liabilities are 4,810 emalangeni. The difference between the total assets and total liabilities is net assets. Then you have the shareholders' equity. In this case, the shareholders' equity is 22,600 emalangeni. It is equal to the net assets. To explain this further, assets are the business resources used to run and grow the business. Liabilities constitute what the business owes. Equity constitutes the shareholders' funds that are invested in the business. Liquidity ratios measure the ability of a business to quickly change its assets to cash and pay off its current liabilities. There are two ratios that we will talk about. The first one is a current ratio, which you get by dividing the current assets by current liabilities. The ratio is 2.73. When the ratio is less than 1, it means that the business does not have enough liquid assets to pay off short-term debts. When the ratio is greater than 3, it means that the business can cover short-term debts 3 times. But this can also be a sign of incorrect use of assets or poor management of working capital. The second liquidity ratio is the quick ratio. You get this by dividing the difference between current assets and inventories with current liabilities. The ratio in this case is 2.4. When the ratio is greater than 1, it means that the business has capacity to promptly pay off all short-term debts. The third set of ratios, which are called solvency ratios, measures the ability of a business to meet its long-term debts and other financial obligations. The first ratio that we will talk about is the debt ratio. You get this by dividing total liabilities by total assets. The ratio in this case is 0.18. When the ratio is greater than 1, it means that the business has a considerable share of assets that are financed by debt, or it has more debt than assets. A more leveraged company, especially in a non-capital intensive industry, could default on its loans if interest increases unexpectedly. The second ratio is the debt to equity ratio. To get this, you divide total liabilities by total shareholders' equity. In this example, the debt to equity ratio is 0.21. It measures the level to which a business is financing itself through debt versus wholly owned funds or equity. It means, can the shareholder equity cover all outstanding debts? A ratio of 2 or higher shows the aggressiveness of the business in financing business growth with debt. In other words, it shows a higher risk of a default or bankruptcy. I hope that you will find these ratios useful and you will be able to calculate the ratios of your own businesses using your business plans and financial forecasts. Thank you.